Hi everyone, my name is Sarah and today we're going to be talking about common financial terms. Now before we get started, I wanted to tell you guys a little bit about me and my qualifications. So I actually have a bachelor's degree in finance from the University of Findlay and worked briefly as a finance manager at a nonprofit organization. I am also certified in accounting principles, financial performance, investment fundamentals, and Principles of Economics by the International Business Management Institute. So let's go ahead and get started. We're going to start off by talking about our income statement, sometimes also referred to as a profit and loss statement. So what your income statement does is it summarizes revenue and expenses generated over a certain reporting period, typically your fiscal year or fiscal year to date. And especially in publicly held companies, the focus on the income statement is going over key metrics such as net sales and earnings per share. So let's talk a little bit more about our net sales and earnings per share since they do play such an important role in the income statement. The net sales, also known as your top line, is net revenue earned from selling products minus your returns and discounts given to your customers. Your earnings per share are the amount of profit per each share of stock. The earnings per share is calculated by dividing net income by the weighted average shares outstanding. Now that we've talked about earnings per share and net sales, let's talk a bit more about your cost of goods sold, sometimes also seen abbreviated as COGS. Your cost of goods sold are expenses to make products such as materials, plants, labor, and delivery. For example, let's say that you hire a truck driver to deliver your product to one of your customers. That expense is then accounted for in your cost of goods sold. Your gross profit is how much money you make after paying for the cost of goods sold. It is calculated by taking the net sales and subtracting your cost of goods sold. Now let's talk about capital expenditures. Capital expenditures are the cost of acquiring or maintaining fixed assets. Some examples of fixed assets include land, buildings, and equipment. Another common abbreviation that you'll see is EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And what EBITDA does is measures how profitable your operations are performing. What it's useful for is estimating the amount of cash the business generates before paying interest or taxes. Next up is free cash flow. Free cash flow is a measure of how much cash a business generates after it pays for capital goods. And examples of capital goods may include buildings or equipment. This free cash flow can be used for the expansion of the business, reducing debt, or paying dividends, among other things. Next up is GAAP. You'll see GAAP very commonly referred to in the accounting world, and what it stands for is the generally accepted accounting principles. In other words, it's the accounting standards that all public companies must follow when reporting financial results. Hi everyone, I just wanted to say thank you for watching my video. If you liked what you saw, please feel free to check out my website at www.sarahborgelt@weebly.com. Thank you for taking the time to watch, and I look forward to hearing your comments.